Property tokenization, the next big investment. Any asset with real-world values such as real estate, land, arts, and trademarks can be converted into a digital representation by issuing a token. A common token used to represent an asset is the Ethereum-based ERC20 token, modified to comply with security laws. Therefore, legally speaking, these assets are securities. Say you're a property owner. Your property is an asset. Tokenizing would mean issuing a number of tokens to represent the value of the asset. You can slice your asset into 1 million pieces and trade them on the market for greater liquidity and asset appreciation. While in theory, the benefits of tokenizing assets come with multitude: increased capital, greater liquidity, immutable tracking, and streamlined transactions. In reality, we still have a long journey ahead before achieving any compliant tradability on the market. First things first, real estate tokenization made easy. Real estate has nearly always been considered a relatively safe investment. After all, whatever happens in the stock market, people will always need a place to live and work. Yet, real estate transactions also tend to be some of the most complex and expensive, rendering real estate itself relatively illiquid. In recent decades, securitization has had some success in making real property interests easier to deal in. However, a new method of engaging in such transactions promises to go even further in transforming the purchase, holding, and sale of real property: tokenization. Things to consider before tokenization. Companies interested in developing a real estate token must carefully consider a host of legal and other issues in connection with their offerings. These issues are highly complex and require the assistance of experienced real estate, securities, tax, and blockchain attorneys and other professionals. Some of the most significant issues that must be considered and dealt with are tax and reporting considerations. Although the Internal Revenue Service has provided a general guidance regarding the taxation of virtual currencies, like Bitcoin, many aspects of how U.S. tax law treats the purchase, holding, disposition of, or income from virtual tokens remains uncertain. Issuers and investors should consult a tax professional for help in developing a comprehensive tax strategy. Moreover, issuers must be aware of any reporting requirements they have, tax-related or otherwise. For example, issuers that rely on Regulation A+ for an exemption from registration under U.S. security laws may be required to file regular reports with the SEC after the offering. Legal entity. Securitization of real estate has traditionally relied on the establishment of special purpose vehicle, SPV, and tokenization will likely do the same. An SPV is a legal entity that exists for a single business purpose, such as to hold and manage real estate. An SPV can be a trust, a limited partnership or corporation, limited liability company, or other entity, each of which has its own advantages and disadvantages. If properly structured, the FPV's assets and liabilities are considered separate from those of the developer, i.e., the company that establishes the SPV, for accounting, tax, and bankruptcy purposes. This allows the tokens to stand on their own merit as investments, without regard to the creditworthiness of the developer. However, structuring the SPV, its ownership, and transactions between it and the developer is highly complicated, requiring the assistance of experienced professional advisors. Smart contracts. Smart contracts are computer code existing on a blockchain that automatically implements and enforces agreements between users without human intervention. Because a smart contract is connected to a blockchain, it cannot be altered once published. Consequently, the smart contracts used to define a token's characteristics and process sales of the token must be carefully designed and vetted before launch. Smart contracts design must make the characteristics the issuer desires for its tokens. For example, if token holders are to receive dividends or otherwise share in profits, the smart contract must so provide. Doing so effectively requires answering questions such as the following. Type of interest. Developers of virtual tokens could choose to tokenize the real estate itself, an equity interest in a legal entity that holds the real estate, a mortgage of the property, a right to share in revenue or profits generated by the property, or any other variation. The nature of the interest being tokenized may influence what regulations apply to the token. For example, if a token that qualifies as an equity security is held by at least 2,000 people, or 500 people who are not accredited investors, and the issuer of the token has more than $10 million in total assets, the security must be registered under the Security Exchange Act of 1934. This requirement is in addition to the general securities registration requirement discussed below. In contrast, tokenized debt may be subject to the special regulations regarding asset-backed securities, which are securities primarily serviced by the cash flows of a discrete pool of receivables or other financial assets. Other considerations. Tokenization ratio. It is possible to tokenize only part of the property rather than the entire property. In that case, however, the details of the arrangement must be negotiated between the owners and made clear to potential investors. Mortgage issues. If the property being tokenized is subject to a pre-existing mortgage, the issuer will usually need to obtain the mortgagee's consent or payoff of the mortgage. If the tokenization is effectively a mortgage itself, then the proper laws will need to be observed. Tracking token holders. Identifying how many people own tokens and who they are will be critical for token issuers. This will typically require collaboration with security token exchanges to track secondary trading and ownership. AML, KYC, Investor Accreditation. Virtual token issuers must be careful to comply with anti-money laundering and know your customer laws and regulations wherever they offer their tokens. We're talking about AML and KYC. If relying on a securities law exemption that only permits accredited investors, issuers must also take reasonable steps to accredit their purchasers. This may include actively verifying that investors are accredited investors rather than just taking their word for it. International sales. Most countries have their own securities laws and AML, KYC rules. This means that issuers must be mindful of the varying regulatory regimes into which they are launching their tokens. A security token offering that is legal in Europe, for example, may be illegal in the United States, or vice versa. In fact, it is possible that one country will treat a token as a security while another country does not. Asset type. If the asset is income producing, who will decide how that income is used? Token holders, a board of directors, trustee or general partner, or a smart contract. Location, location, location. Location of real estate is important for practical reasons. Nobody will buy a condo in the middle of nowhere, but also for legal reasons. Not every country provides protections for private property rights as strong as those in the US do. While the tokenization might happen in a different jurisdiction, one can never escape the situs at which the real estate is actually physically located. Can the economy actually become tokenized? It may be too bold of a statement to say that a totally tokenized economy can become a reality, but it is fair to say that it is emerging. The potential of tokenization is being widely recognized in many of the most powerful nations worldwide. A large part of the economy is already digitized anyway, considering the usage of apps to make purchases and send money. A tokenized economy would only take things to the next level. The scalability element may take a while, but then again, the concept behind tokens is far from new. Things such as ID cards, concert tickets, loyalty program points, club memberships, dinner reservations, and much more, all within the same realm. In its current iteration with blockchain and cryptocurrency, tokenization represents the future of financing.
That's all for today. If you have any question regarding crypto, do not hesitate to reach out to us in the comment section. To continue enjoying more of our crypto videos, kindly subscribe to our channel. Do us a favor by liking, commenting, and sharing our content with friends or across social media channels.